Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning, everybody. It's Monday, July 8th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, I can be found intra-week on LinkedIn, Herb Morgan, or on X, @_ETF strategist. Presentation you're about to see and or hear has been prepared by us, Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor. It is intended for use with both financial advisors, planners, and individual investors, but each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as advice, investment, tax, or otherwise. There are no recommendations for the purchase or sale of any securities. The opinions reflected in this presentation are mine and mine alone and do not necessarily reflect the opinions of Cantor Fitzgerald, its affiliate, its parents, or other portfolio managers within the firm. Well, let's get right into it. Pretty good week, actually, again, for equities, but as measured by the S&P 500, up almost 2%, as you can see here. That's pretty sizable move. Let's get the laser pointer out. Here we go. Mid and small cap stocks both declined. So this continued theme and trend ahead of earnings season, which is starting this week with the financials and Delta Airlines, a couple others, is all about big cap names. Now, at some point, we're going to start hearing about antitrust concerns and the government getting involved in that. And that'll be the time to start worrying about large cap and large cap tech. But right now, it just seems to be game on for large cap, which is completely dominated by technology. Wow, how times have changed. When I started in the industry back in the 1980s, big cap US was dominated by the energy companies. Energy companies represent about 3% of the market capitalization of the S&P 500 today. International markets participated on the large cap side, and bonds caught a bid. Interestingly, we saw the 10-year, looking at my notes here, drop from 439 to 427. 20-year yields went from 466 to 456 on the week. So you saw a big bump there in the longer 20-plus year Treasury index. Let's get into the economic data last week because it was pretty mixed. There are definitely now, I think, conclusive signs of slowing. The conclusive signs of slowing contribute to disinflation. The contributions to disinflation will allow the Fed to get closer now to that first rate cut, which markets now believe is in September, which is only 2 months from now. I still think they'll wait for November because I think even though it's warranted, it's fine. You could do 25 in September. I think that the Fed will push it past the election because they're very concerned about maintaining that aura of independence. Don't want anybody to have reason to doubt their truthfulness, to doubt their sincerity in any way. Fed independence is critically important to the U.S. economy. Let's start with S&P Global. Used to be called Marquette. S&P Global, the manufacturing PMI. Remember, manufacturing about 15% of the U.S. economy. You can see there rose from, looks like 51.3 to 51.6, a little bit below expectations. Much better than a year ago. And employment actually rose as well. So we're happy with that number. But then the competitive numbers, this is something that measures the same thing, from ISM said, no, we're actually below 50, and it fell again from 48.7 to 48.5. New orders are up a little bit. Production fell. Employment fell into contraction. And what's interesting here is inventories dropped. Producer backlogs both fell. That means that the underlying manufacturers themselves are getting less confident, less willing to hold more inventory as the economy begins to decelerate and slow. Now, services, a much bigger component of the U.S. economy, about 85%, as measured by S&P Global, and then I'll show you the ISM. The S&P Global, formerly Marquette, measurement there says, hey, 55.3, that was above estimates, right in line with the prior month in May. everything was great. Okay. And then we get ISM and we have this big drop. You can see this huge drop here from month over month, fell to 48.8, well below the 52.7 estimate, and the 53.8 or almost 54 in May. And in this reading, in this statistical methodology, they say, hey, this big post-pandemic splurge in spending we had on leisure activities, travel, dining out, all of those things we were forced to give up during that violent economic closure related to the COVID pandemic. All of that seems to be waning now. We've got it out of our system, in other words. And we saw business activity in the services sector contract, new orders contract, and businesses focusing. Here's that thing they were seeing again, inventory reduction. This is what definitely says, hey, we are slowing down. The economy is slowing down, which then takes those odds of a Fed rate cut. Those odds go higher. Construction spending for the month of May fell 0.1%, still 6.5% or 6.4% higher than it was a year ago. Automobile sales still lagging. Still, you've got the pandemic shutdown, you got the pandemic surge. You had, we go back, 08's not on here if you remember cash for clunkers, but we were in that sort of 17 million annualized rate back here. And now we're just not. You can see it came in at 15.3, below expectations. Part of that, the product is better. It's lasting longer. That's good news, right? We're getting more efficient with automobiles. Another part of that is consumers sort of overwhelmed by technology and not wanting to, hey, I know how my car works. I don't want to learn another one. Very common thing that we're hearing, the overcomplication of the automobile purchase. And then, of course, there's just, the cars are lasting longer. They're better product than they used to be. Jobs openings, or JOLTS, which had gotten over 12 million upon the reopening after the forced closures during the pandemic, rose from about 7.9 to 8.4. That's well down from that 12 million level. Now, the balance of trade, deficit or surplus, you can see we pretty much always run a perpetual deficit here in the United States. And it's a subtraction from GDP, the way GDP is calculated. I don't necessarily see it as always a bad thing. It means we send dollars abroad, we get things in return. It helps keep inflationary pressures down if we're buying them from companies with lower cost of production. But that trade deficit came in at 75.1 billion. You can see the trend here in the last 6 or 7 years has been an expansion of that trade deficit. Now, going back to my early career in the 80s, and the 90s, and 2000s, much of that trade deficit was really attributed to energy and a petroleum deficit. This is less and less the case today, more of a goods and services deficit because America is a very wealthy country. We have the world's reserve currency, and the dollar is sovereign and purchases quite a lot of things. Okay, moving on. Factory orders for the month of May, down 0.5%. That's a volatile series. I wouldn't read anything into that. You can see we have some down months and then we have some up months. Nothing really to be overly concerned about there. We are continuing to see that slightly elevated level on weekly initial claims for unemployment. This is slightly elevated from unbelievably good to just very good. This is a very good number. The jobs market is not falling apart because we've gone from 200,000 to 238,000. We have a very big, 330 million people, 157 million people in the workforce. So if 238,000, are laid off because there's just normal cycle, ebb and flow of business creation, reduction, things happen. These are healthy numbers. But what I am seeing is continuing claims, continuing to just every week go up just a little bit more. And I can tell you the folks that set interest rate policy at the Federal Reserve, and remember, they've been given this mandate from Congress of price stability, i.e. handle inflation and disinflation, a secondary mandate, which many believe is in conflict with the first and should not be as part of the Fed's agenda. But Congress has told them it is, so it is for now. That employment part continues to go up. And so the Fed will see that and see unemployment clicking up. The unemployment rate has clicked up. We'll get to that in a minute. They'll look at that and say, well, the Fed would need to cut rates. problem with cutting rates is we still haven't gotten that inflation back down to the level. And so those two mandates are somewhat in conflict with each other. We got the jobs reports last week. The first one we get is the ADP, Automatic Data Processing jobs report. Their statistical method suggests that the U.S. economy added 150,000 jobs in the month of June. That's great. You can see, though, it's at the lower end of where we have been for the last 4 years or so, right? Big surges coming off the pandemic, slowly coming back down. We're down there, but still positive number and welcome, of course. The Bureau of Labor Statistics, that's the official government jobs report, says we added 206,000. That was a little bit above expectations. But this was the one that got the market a little spooked. Not enough to spook it away from going to an all-time high last week. And again, this morning, we're at another new all-time high in the S&P 500 and the NASDAQ. But we were revised lower to 218 from 270,000. And again, that unemployment rate kicked up to 4.1. And there's so many ways to look at data and labor market, but one of the things I look at is what are the total number of people employed in the country? And that was, maybe 159 million, dipped down to maybe 158, 157. And so you've got rates, you've got adds, you've got subtracts, you've got weekly claims. But the bottom line is the labor market is starting to moderate. It's moderated considerably, and the total number of employed people in the U.S. has gone down a little bit. It's not panic time, but the Fed's got a keen eye on that, and that's why the world interest rate probability screen, I'm not going to show you today, I've showed you before, that screen is now saying that the first rate cut is more likely September. It's because of this labor market weakness. Again, though, I think the Fed cares more about its long-term reputation as being apolitical and very independent. Why give a rate cut right before the election in November when they've got a meeting on November 7th? It's only 25 basis points. I believe they're going to wait. Then there's those things that are just still giving us concern and the biggest thing I think of concern to U.S. investors, the world, the U.S.'s position as the world's reserve currency, which enables us to have these deficit spending and this unbelievable amount of government services and military spending and the highest quality of life and standard of living in the world, is this reserve currency issue. But it's being threatened by deficit spending, which compounds into debt on the balance sheet. Now, this is not the Treasury's balance sheet. What I'm showing you here is the Federal Reserve's balance sheet. This is when we're issuing so much debt that the Federal Reserve, that the market won't absorb it without interest rates going through the roof. So the Federal Reserve comes in and buys it. And this is a way for them to force interest rates lower to try to stimulate the economy. They do this in times of recession. And then when the economy is doing well, they're supposed to let that balance sheet run off. And you can see they built up their balance sheet right here during the recession of 2020, the COVID recession. And then ever since then, they have been letting some of that debt mature that sits on their balance sheet, can be treasuries or mortgage-backed securities. And they've been letting it roll off. And that's good. That's what they're supposed to do. That's helping. That's disinflationary. And but debt, this is not debt to GDP. This is just Fed balance sheet debt to GDP at 26%. At 26%, that is incredibly high. This number over here was well below. This is in the 18, let's call it 18% range before the pandemic. But if you go back before the global financial crisis of 2008, it was half of that. It was very, very, very low levels. So even though it's directionally going well, this is of great concern to us and should be as investors. And then this is the actual debt to nominal GDP, not B, but P, debt, gross domestic product. U.S. debt now totals $35 trillion. That does not include unfunded trust fund mandates, for example, Social Security and Medicare. And then this debt as a percentage of GDP, this is about 125%. Looks like it cut off a little bit there. Sorry about that. About 125% of GDP. It is a little bit below where it was coming out of the recession, but that was just because GDP collapsed because we forcibly shut down. The trend is here the trend is unsustainable, according to the Secretary of Treasury, Janet Yellen, in her annual report, which she's required to produce as the Secretary of Treasury, annual report on the United States fiscal situations. So no matter, I know we're in an election year, I know no matter who you like or don't like, the next Congress and the next president collectively must rein this in. This is at the kind of level where it becomes incredibly important to long-term sustainability of a country. Now, to be fair, there are economists who believe we could take this number far higher without any consequences. I don't really want to find out. I would much rather get the reforming of spending policy and output from federal bureaucracies would be helpful to our portfolios here for all of us. Anyway, moving forward this week, economic data. Consumer credit will be out this morning later, looking for expansion by about $9 billion. Small business optimism on Tuesday, nothing Wednesday. We really don't get into the big stuff until Thursday, Friday. We've got initial claims for unemployment, 235, CPI on Thursday, PPI on Friday, and then consumer sentiment from the University of Michigan will be out on Friday as well. We do begin earnings reporting season for the June 30 quarter this week. As you remember, it's really financials generally start, and there's this kind of wave of financials, and this is week. In addition to Pepsi and Delta Airlines, we've got Wells Fargo, JP Morgan, Citi, BlackRock, and Goldman Sachs. They just got through their stress test, so you might see some announcements on dividends. You might see some announcements on stock buybacks, i.e. the ability to return capital to shareholders. Remember, this is a podcast. This is also a YouTube channel where you see the graphs and charts that I'm talking about, all the different podcast formats. Thank you for tuning in. I'll be back to you again in 1 week. Thank you.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.